Hi, everyone. Welcome back to Atrium Research's YouTube channel. Today, I have the pleasure of interviewing Aurora Davidson, the CEO of Amerigo Resources, which trades under the symbol ARG on the TSX. We cover Amerigo with research coverage and have a buy rating and a target price of $3.50 per share on the company. Amerigo is a copper producer which processes fresh and historic tailings from Codelco's El Teniente mine in Chile. Aurora, thanks for being here today.
Thank you, Ben. It's good to be chatting with you again.
Hmm. And we've got lots to talk about. This morning, you published your Q3 financial results, which we're going to get into in detail. But congrats, it was a strong quarter. The debt announcement of the debt being fully paid down, as well as increasing the dividend. Lots of different catalysts for the story. In terms of investors, clearly today they're quite happy. The stock's up over 14%, I believe, as of right now. But maybe for the listeners that don't know the story, could you give us a quick 2 to 3 minute overview of the company, what you do, and then we'll get into some Q&A about all of the different news over the last few months here.
Absolutely. Yeah. Thanks, Ben. It's good to do that little recap. We have a lot of new investors and people following Amerigo since we last spoke. So it's a great opportunity to touch on our general story. And so Amerigo is a copper producer, but we're not a miner. We call ourselves a copper factory. We produce copper exclusively from processing or reprocessing the tailings of the world's largest underground copper mine, which is El Teniente mine, located in Chile. We have been doing this as a company, as Amerigo Resources, since 2003. But our operational entity in Chile, which is called MVC, has been doing it for 33 years now, since 1992, uninterruptedly. So there's a lot of history behind the company and its operational reliability and standing, which is one of the key features of a company. So when we're talking about producing copper from fresh tailings, it's a whole different story from many different points of view. One of them is, of course, we are processing very low grade material because this is the residual material that is coming out of the mining process. So our strength lies in knowing how to work with that low grade material. We do work with huge volumes. The amount of tailings that we receive on a daily basis from the mine is significant. Those are called fresh tailings. And we also get to process historic tailings, which are tailings that were deposited by El Teniente adjacent to our plant. So they're quote unquote stored as dry tailings. You've been to the site. So you can tell people that it's not a small warehouse where those tailings are stored. It's a
No.
significant area of operational. It's a significant area. We had one person visit NBC recently. He said, "I felt I was walking on the moon. It was just like
Yeah.
a very different terrain from what he was expecting." So in any event, we produce around 60 to 65 million pounds of copper per year by processing those tailings. This is about the mid range production. So what a mid-sized copper mine would produce, that's what we're producing on an annual basis. And we do it in a very consistent way because our operation is focused on the concentrator. So the more industrial part of processing copper into a copper concentrate. We don't have all of the significant steps that mines have to take in order to blast, hold, transport all of their ore into the concentrator. We basically just get it as a slurry and we process it from there on. We produce a copper concentrate that is exactly the same as what a mine would be producing. So we're not producing a subpar type of copper. I get this question a lot, so I want to address it beforehand. And we sell that copper concentrate into the market at market prices, which is essentially one of the fundamental strengths of the company. We're 100% levered and exposed to the copper market, which has been behaving quite well in recent years, including in the last month or so. So in general terms, that's the operational aspect of our company. Another significant aspect I would like to comment on is the fact that we have already reached our growth targets. And I'm sure we're going to talk about that when we address the debt repayment. So we don't have capital growth envisioned ahead of us. We've already taken the plunge and paid now for that growth. So that gives us the unusual position within the mining industry of being able to return essentially most of the cash that is generated by the company as free cash flow to our shareholders. So 4 years ago, we created what I think is one of the most unique strategies in the mining industry to return capital to shareholders. We call it our Capital Return Strategy, or CRS. And with that strategy, we have returned more than $90 million to shareholders since 2021. So that's our recap. We had a good quarter, Q3, and we can go over the details of that quarter in the Q&A. And there have been important subsequent events to September 30th to discuss, and you mentioned them being debt-free. So I think that's a good recap, and we can move on to the Q&A, Ben.
Yeah, yeah, please. And thank you for that overview. And yes, let's get into it. So today's announcement, the Q3 financials, we'll get into the financial side of things in a little bit, but a couple major highlights in there. And I mentioned earlier the full debt repayment. So maybe just at a high level first, and then we can get into the impacts of that. But for the listeners, maybe you can talk about what that debt was used for initially, and then your plan and what you have done over the last year or two in terms of aggressively paying down that debt, why you paid it down so aggressively, and then we can get into the dividend side of things after that.
Sure. So that debt was taken initially, we took it in two phases, but initially in 2014 with a 64.4 million loan. These are all US dollars to expand our production capacity. Just to give you an idea of where that idea came from, we were producing around 39 million pounds per year. That was our actual production in 2014. And we wanted to expand our capacity at MVC to be able to process all of the fresh tailings that came from El Teniente. And we also wanted to be able to process the historic tailings from Cauquenes, which is the deposit that we're working on now. And in order to do that, we needed to invest around $100 million to do so. So we didn't want to dilute our shareholders by basically issuing out a significant share offering. And we took the unusual, very unusual position in the mining industry of doing that expansion fully with debt. And based on the credibility of the asset that we were working with and on the long-term prospects that that expansion was going to be generating for us and also for Codelco, who owns the tailings that we're processing, right? We're sort of partners with them through our contractual arrangement. We wanted to benefit with that additional production, both parties, and not dilute the shareholders in the process. So we took in 2015 $64.4 million of debt. And then we did a second phase of our expansion. We had de-risked it in terms of execution risk by dividing it into two phases. 2017, with the first phase complete and running, we did a second phase of expansion, and we took on a second tranche of debt, $35.3 million, so essentially $100 million of debt that was fully allocated to expanding the production capacity at MVC, and it worked. So we moved from producing 39 million pounds of copper in 2014 to producing 65 million pounds of copper last year, with very consistent production in the last years. And 4 years ago, we refinanced our debt, repaid a significant portion of it then, and kept $35 million of debt in the books, which we were amortizing at a rate of $7 million per year. We had a plan to amortize that debt over 5 years. and we're completing that ahead of time in 2025. So essentially, just almost a year before our final debt repayment was due, we had the cash and we had guided the market that we had this objective of becoming debt free this year. So we just completed that transaction a few days ago.
Mhm, mhm. Well, and the idea there is firstly, obviously being debt free, but what that does is free up additional free cash flow. And so as a result of that, you also announced this morning increasing your dividend by roughly 33% from 3 cents a share to 4 cents a share. That brought the annual dividend yield to 5.8%. I think it's a little bit less than that with the share price rising throughout the day, but maybe you can talk about that increase in dividend and where that capital is coming from. I sort of just alluded to it, but maybe you can touch on that.
By being debt free, we are releasing or becoming more cash flow proficient in the tune of around $9 million, give or take. We were amortizing debt at a rate of 7 million per year, so principal payments of 7, and our interest expense varied, but last year it was $2 million. So if we take last year's figures, it's $9 million that are becoming available through the debt extinguishment. And as I mentioned before, there is no significant capex lined up ahead of us. We have sustaining capex, we have optimization capex. This year, our range of capex is around $13 million because we have some very interesting optimization projects there that are starting to yield good results, as you've seen in Q3. And so, yeah, most of that additional free cash flow is free cash flow to equity.
Amazing, amazing. And so in the press release, I think it said, yeah, roughly 50% of that newly available cash flow is taken up by that increase in dividend, which leaves the remaining 50% to the bottom line, which I imagine you can incorporate into your sort of three levels of returning capital to shareholders, which is dividend, um, buying back shares as well as the performance dividend. So maybe you can touch on, we can get into that capital return sort of strategy that you have and what that looks like going forward now that you do have this additional cash flow coming in.
Sure. Well, our capital return strategies is it has three different mechanisms of returning capital to shareholders. We acknowledge when devising the capital return strategy that there's cyclicality within the copper sector. You can have significant fluctuations from one quarter to the next, even if you're in a high copper price environment. And so what we wanted to do was to have a mechanism to return capital consistently to shareholders in what could be considered the floor. So that was a quarterly dividend. And the spirit of the quarterly dividend is to have a dividend rate that is safe, that is secure, that can sustain cyclicality from quarter to quarter, and that people are able to consider that almost as a fixed income stream, or they can consider it a fixed income stream in their portfolio. So we do not want to have that risk factor embedded into the rate of the quarterly dividend. We started our quarterly dividend with 2 cents per quarter Canadian. We increased it almost in the second quarter of the dividend payment for a quarterly dividend of 3 cents Canadian, and we kept it there for 16 consecutive quarters until now. We have a structural change within the company driven by the debt extinguishment that allows us to take that step forward into a dividend increase of 33%, 4 cents Canadian per quarter, because we feel safe. We feel safe in saying structurally, we now have that additional room to allocate this consistently and without having to adjust it later on for the shareholder. So we are a conservative crew. We are not going to be taking a full um, um, just allocate fully that $9 million that we spoke of that is being freed up in one go. But I think this is a very aggressive position from the board, but a cautious one at the same time. It is a significant debt dividend increase, but it's not taking up the full amount that has been uh, that has become available. It makes a lot of sense for people that have been following us. They know that we are, this is a steady race. We're a long-term company. We have a long-term asset. We want to have long-term shareholders, and
Yeah.
we're doing things step by step, but those steps are significant and are consistent. So we're building up on past
Yeah.
successes. So that's one of the things that has happened. So we have two other tools to return capital to shareholders. Um, if you put the two together, there are additional distributions. So beyond the safety, security, and reliability, consistency of the quarterly dividend, if there's additional cash to return, and we think there will be additional cash to return, we have share buybacks and we have performance dividends. The performance dividend has a quirky name. It's a special dividend, but it's based on the performance of the copper price. When there is a significant spike in copper prices, you are well positioned to do a performance dividend, and we've done that before. This could have been for example, a good instance of doing a performance dividend, but there was also that structural change that prompted us to consider and to conclude that the time had come to do a long-term change to the quarterly dividend and leave something there additional on the table for additional distributions as they are needed.
Yeah, no, that's great. And it's nice that you're able to have those different levers to pull on. And like you said, the cyclicality, I mean, even the copper price, I had someone reach out to me today just on the back of the note we put out, and he's asking about my EBITDA estimates in 2026, and I'm saying, well, we're using a bit more conservative of a copper price because I think just since August, copper's up, close to $1, a little bit less, but there's lots of volatility there, and so it makes sense to have the standard dividend, some upside with the performance if copper price does well, and then even with some leftover with buybacks. So, um, yeah, maybe you can just touch on you guys like to have a certain amount of cash on your balance sheet. This can sort of settle stomachs from a risk perspective if there was any issues on site. Maybe you can just talk about that a little bit, because you're again staying on the side of conservatism, in case things happen on site.
Have a cash buffer. We speak generally about a minimum cash target of $25 million. Um, it's a guide. It's not a given figure. For example, we ended last year, 2024, with more cash than that on the balance sheet, but we also had a significant amount of taxes payable, which were coming due. So you're not gonna just, distribute all of
Yeah.
your cash and then tap on your line of credit to pay your taxes. So there's common sense embedded in everything that we do. So, $25 million in cash is give or take a trigger point for a potential performance dividend. But we also have to consider what's happening on in the market. And I think we've spoken about this before. If we had $25 million in the bank and we saw that we were going into a period of certain cyclicality with copper price adjustments, we would be cautious. We would be cautious. So this is a
Mhm.
long game. There's a commitment through the CRS. There are specific we try to provide as much guidance as possible, but there's also common sense and management judgment involved in everything that we do. And of course, we have a board that reviews financial results every quarter that is in tune to the copper price environment, and those factors drive a lot of the decision making. But there's been a consistent trend in how we operate and what we're doing, and I think the overall thematic here is the commitment of returning capital to shareholders.
Yeah, yeah. Well, no, and you mentioned consistency. I mean, even the consistency is reflected in the stock price. It's been one of the more steady stocks to own over the last 5 years with all of this volatility, as we discussed earlier. And a lot of people would look at Amerigo to be sort of a um, conservative. You get your dividends, some share buybacks, slow rise, but but even then, the stock's been performing really well as of late, as people have started to notice this, um, you know, strategy you have to be able to participate in the copper space. So pivoting over to the quarter in particular, on the production side, you guys did face a little headwinds um, with what happened at the El Teniente operation. Maybe, I know this is mostly behind us as we're into Q4 now, but it might be good for you to just touch on the shutdown on site and then what measures you took to minimize the impact on production. I think it's notable to highlight, how you guys were able to act quickly to minimize that impact. And then maybe you can just lead into a little bit of discussion between the fresh and historic tailings, and obviously why ARG prioritizes the fresh tailings.
Sure. In respect of the specifics of Q3, there was an accident, a very unfortunate accident at the El Teniente mine, who supplies our fresh tailings on July the 31st. There was a seismic event. It caused a rock blasting incident within the mine. And as a result of that situation, mine operations were suspended fully for 10 days. So for those 10 days, we did not receive any fresh tailings on site. We continued operating because we were able to do so by processing historic tailings. And we ramped up our production or our activity within the historic tailings site in order to maximize the amount of tailings that we could produce from there and thus mitigate to the extent possible that shortfall within those 10 days. And we have continued working with more historic tailings material because we haven't yet returned to the normal throughput, the normal volume of fresh tailings from the mine to MVC. But what that also gave us was the opportunity of reutilizing our real estate. Our real estate is a concentrator. So we have a fixed capacity within that concentrator with significantly lower volume coming in. Our team was able to just redirect some of the flows. We have obviously much better classification because we have lower material to classify. We increased our dilution to improve classification further, redirected flows within the circuit, increased residency time, etc. So it was basically a way of allocating or utilizing that additional plant capacity in the best way possible to increase recovery. The three factors that lead to production are your throughput, that's your volume, your grade, and your recovery. So just tweaking those operational drivers to increase recovery has helped us mitigate the lower volume that we're getting from the fresh tailings, in addition to the additional processing of historic tailings. So in general terms, our production impact was limited to August, which is essentially the month where we had the 10-day stoppages from the mine. Production in September and in October has been quite good.
Great. And yeah, I think it again just proves that you guys are able to make these pivots and adjustments quickly to minimize those issues. Um, just touching on the production from El Teniente, is the tailings at full capacity now, or did I just hear that it's almost back up?
We don't have yet the full volume of fresh tailings that we had in our mining plan for this year, but that doesn't matter. We are complying with or we're reaching our production targets now
Mhm.
through those operational adjustments and through tapping on to more historic tailings. So the end result in terms of the output from MVC, we don't have any impact on production in September or in October as we speak. We just checked out our production numbers for October. They're pretty good.
Great. And yes, I guess maybe just on the production numbers, going forward Q4 and then into 2026, I imagine you can get back to Q1, Q2 levels of 2025.
Q1 and Q2 of 2025 had impacts associated with our plant shutdown.
Right.
We provided a revised guidance, 60 to 61.5 million pounds of copper. If you take what we have produced to September 30th and you get the delta to that guidance, we will be having a pretty strong Q4 of 2025.
Great. And going forward, 2026, I imagine even could be improved over 2025, not including Q3 if that was steady state.
All things being equal, yes, we would expect not to have that sort of interruption factor embedded
Hmm.
into the 2026 budget. We are in the middle of preparing our 2026 production budget, operational cash budget, CapEx. So it's all in the works. It's a changing environment as well in terms of what could happen, for example, with treatment and refinery charges. So it's an interesting time to be a copper producer. I know that we always say we're not a mine, but we're a copper producer, and the drivers that affect the copper market affect us. It's a strong environment in terms of pricing, and we see that going forward into 2026 as well. Um, uh, so it's interesting times, Ben.
And we'll get into that in 1 second. I did just want to ask, back to the financials on the margins this quarter. There was a little bit of margin compression. Is that primarily because of the shutdown? And can we expect margins to bounce back into Q4?
When you look at margins, you have to look at two factors separate. One of them is revenues, and the other one is the cost side. And within revenues, it's very, very difficult to provide um, a stable commentary when you're in a period of rising copper prices as we are now because of the settlement adjustments that transpire from one quarter to the next. You saw that in Q3 of 2025, we had positive settlement adjustments. And basically that was only from the appreciation in copper prices that we saw in the month of September because July and August were not particularly strong copper price wise. Since the end of the Q3, copper prices have changed substantially. So as we
Hmm.
speak right now, uh, there are substantial positive settlement adjustments coming online in Q4 of 2025 that will be significant on the revenue line. So trying to predict the margin without considering those pricing adjustments will leave you with a totally erratic figure. So I don't want to sort of narrow the discussion just to that. So
Hmm.
just keep that in mind. In terms of
Hmm.
costs, what do we have there? We have tolling and production costs. Tolling and production costs uh, uh, would be very similar to what we saw in Q3 of 2025. We have some impact from the days that we didn't produce, which would be a cost reduction. But since we've been working more with historic tailings, we have higher costs. We consume more lime when we're working with historic tailings. We consume more water, so industrial water cost and historic tailings processing cost. All of those are broken down in our MD&A, and it's very easy to follow them. So but in general terms, I don't expect big surprises on tolling and production costs. The moly royalty is considered a cost of production. Um, with higher moly prices and higher moly production, that royalty goes up a little bit, but it's a good cost increase because
Yeah.
there's a counterpart to it on the revenue side. But revenue adjustments will most likely produce, if we continue to see this copper price behavior in November and December, um, a significant bump up in the revenue line, which will result in
Hmm.
higher margins.
Great, thank you. And Just quickly, and we'll get back to this copper price. On the maintenance CapEx side of things, you mentioned a little bit of a different year this year. What can we expect in 2026? Are there any major CapEx initiatives? Maybe not major, but
No, no, not major. I mean, you wouldn't expect us to come up and say, suddenly next year we're going to be having a $20 million CapEx project. That's
yeah,
not going to happen. So we're essentially looking at the usual, the sustaining CapEx. If there are good optimization projects that have a good ROI, we will consider them, but we're still on um, creative mode. We're looking
yeah,
at what the 2026 budget is going to look like. We usually present the first news release that we issue out in any given year is the most important one in my view. We just report our production results for the prior year, but we also provide a very detailed guidance on what to expect in the following year. And I don't see anything different or completely novel coming up in
right.
2026 from what we had in 2025.
Great. Thank you. And then, yeah, so going back to the copper prices, you mentioned copper prices are quite high right now. Current price levels being outside of the agreed upon range for the fresh tailings with that component of the business. Can you maybe just remind investors what that means for Amerigo, and then what we can expect as far as negotiating and talking about a price range for the royalty there?
So just to explain what that royalty is, the royalty is our compensation, the compensation that we pay to El Teniente for letting us process their tailings. It is their tailings from beginning to end. We return those tailings to them. We just get the right to process and extract copper and molybdenum from those tailings before sending them off to their tailings deposit. So it is a way of sharing the benefits of the business with them. And it is the prime mechanism that aligns us with Codelco, through which we partner. They become essentially recipients of a percentage of the business through that royalty. So it is important for them to have a fair and good compensation coming out of this because it keeps them motivated. And it's one of the reasons why we've been business partners through this arrangement and this contract at MBC for more than 32 years. So the current contract has a price band. There's a cap on the lower range and on the higher range for moly, for fresh tailings, and for historic tailings. And when you fall outside of that band, you basically just have to sit down and do one thing: continue that compensation formula, that royalty formula that already has a slope. So essentially, if you want to look at it, it's the continuation of that slope at a higher price range. That's the only thing that happens. We've had it occur to us once with Molly, and it was a very smooth, simple discussion, and we expect that that will happen again. When does it happen? It happens in this specific case of fresh tailings when there are more than 2 consecutive months of copper prices, average LME copper prices over $4.80. So far this month, the average LME copper price is 4.83. So October would be the first month in which we see that condition. If in November we also see that, then we start those discussions in December the 1st or later, but not before.
Hmm. Okay. Understood. Understood. Excuse me. That's good to know and provide some clarity there. And I don't imagine there will be any issues arising if that does happen. Not to mention, we all like high copper prices, so that will come with some positive reinforcement. So look, Aurora, that's all I had today. Firstly, congrats again on the strong year so far, as well as the announcements this morning with the debt pay down and the dividend increase. Again, shareholders seem to be quite happy, and we're looking forward to seeing Q4 in a few months from now, and then 2026 and moving on. So for our followers, if you haven't seen our research on Amerigo, you can find it all on our website at atriumresearch.ca, as well as the research note we published this morning on the Q3 results. Again, Aurora, thanks for your time today.
Thank you, Ben. Look forward to chatting again in 2026.